So now we are going to solve one of the questions from CASNEB past papers. So this is August 2025, and then we are going to solve question 3. So this is question 3, CPA August 2025. So the question says, Anita and Banse are in partnership, sharing profits and losses in the ratio 3:2 after charging annual salaries of 1.2 million and 1.5 million to Anita and Banse respectively. Both partners are allowed one-time interest at a rate of 4% on opening capital accounts. On 1st December 2024, they admitted Carol and agreed to share profit and losses in the ratio 5:4:3. The partnership trial balance as at 30th June 2025 was as follows. So from those two paragraphs, the first paragraph we have the old profit sharing ratio 3:2, and in the second paragraph we have the new profit sharing ratio 5:4:3. That is after they admitted Carol into the business. So we are provided with the trial balance for the year. Then we go to additional information. Number 1, you are told that Carol has been the office manager, and for the year commencing 1st July 2024 was on a salary of 1440,000 per annum. And then number 2, interest on capital at the end of the year was a one-time rate of 5%. So at the end of the year, the interest rate has changed. So this is 5%, but at the top, we were given a different rate. So at the top, the last sentence in the first paragraph, we were told that both partners are allowed one-time interest at the rate of 4% on opening capital accounts. So note that it says both partners, that is before they admitted Carol. So 4% is the rate they were using before they admitted Carol. But after they had admitted Carol, the rate changed from 4% to 5%. So we are going to use 4% for the period before admission and 5% for the period after admission. Number 3, Carol introduced a motor vehicle valued at 600,000 and 1.5 million cash as part of her capital contribution. The only entry made in respect of Carol's admission was 1.5 million paid into the bank account. So according to point number 3, Carol introduced two forms of capital. So one is in form of asset, which is motor vehicle. The other one is in form of cash, 1.5 million. But for the cash, the entries were made in the books, and for the motor vehicle, there were no entries made in the books. So we are going to make adjustments for capital introduced in form of asset. So if we go back to the trial balance, you look at the capital balances given in the trial balance. We have Anita, Banse, and Carol. So the amount recorded here for Carol is 1.5 million. So this is the amount that she introduced in form of cash, 1.5. So it means that she was not credited with capital introduced in form of asset. So that is something we are supposed to adjust before we prepare the statement of financial position. Number 4, on 1st December 2024, goodwill was valued at 3.6 million and is to be written off. So we are going to account for that. One thing you are supposed to note here is that the goodwill has been valued, and we are not told that the partner paid the goodwill in cash. If you go back to point number 3, Caro introduced two forms of capital, 600, that is the value of the motor vehicle, 1.5, that is her share of capital, which was paid in cash. So we are not told that she paid for goodwill in cash. So in this case, we are going to account for goodwill valued but not paid in cash. Number 5, inventory as at 30th June 2025 was valued at 74,25,000. So that is the closing inventory. Number 6, 1/3 of the year's sales were made before admission of Caro and 2/3 after her admission. So this means that Caro was admitted in between the financial year. So we have to determine the number of months from the beginning of the financial year to the time of admission, and then the number of months from the time of admission to the end of the current financial year. Number 7, accrued expenses included 30,000 for insurance and 250,000 for rates and rent. Number 8, cost of sales and gross profits are apportioned according to sales, while all other expenses are apportioned according to time. And then lastly, number 9, depreciation is provided per annum at the following rates: motor vehicles 25% on a straight line basis, equipment 20% on reducing balance. So required: statement of profit or loss for the period ended 30th June 2025. Number 2, statement of financial position as at 30th June 2025. So the first thing is for us to determine the number of months since the beginning of the current financial year to the date when Caro was admitted. So now let us check the date when Caro was admitted. In the second paragraph, we were told on 1st December 2024, they admitted Caro. So that is the date when Caro was admitted, 1st December 2024. So now let us check the date when we are preparing the financial statements. That is the end of this financial year. So if you go to the required part, we are required to prepare statements for the period ended 30th June 2025. So 30th June 2025 is the same date as the trial balance here, 30th June 2025. So we want to count the number of months since the date when Caro was admitted, 1st December 2024, to the date when we are preparing the financial statements, 30th June 2025. So in the year 2024, that is 1 month, that is December only. In the year 2025, we count from January all the way to June, and because this is 30th June, we are going to count the whole month of June. So those are 6 months in the year 2025. And then we add the 1 month for the year 2024. So we are going to have a total of 7 months. So after the date of admission to the end of the year, we have 7 months. So which means since the time the year began up to the time Caro was admitted, we are supposed to have 5 months. Whenever a partner is admitted in between the year, we are supposed to apportion income and expenses. That means that the income statement should be divided into 2 columns. One column, the period before admission, and the other column, the period after admission. So this is the format we are supposed to use to prepare the statement of profit or loss. So notice we have the 2 columns there. One is before admission, the other one is after admission. And we have already determined that before admission of the partner, the business had stayed for 5 months, and after admission, we have 7 months. So we are going to apportion all the income and expenses into those two periods. So let us start with sales. If we go to the question in the trial balance, look at the amount of sales. So sales is the first amount shown in the trial balance, and the amount given is 61,800. So some of the sales were made before admission, other part of the sales were made after admission. So to know how we are supposed to apportion those sales, we will go to additional information number 6. So number 6 says 1/3 of the year's sales were made before admission of Carol and 2/3 after her admission. So in the first period, we will take 1/3 of the sales. In the second period, we will take 2/3 of the sales. So the sales amount is 61,800. So in the first period, we are going to take 1/3 of 61,800, and then we record it in the period before admission. So 61,800 we divide by 3, or we multiply by 1/3, gives us 2,600. And then for the next period, we are going to take 2/3 of 61,800. That is the period after admission. So 61,800 multiplied by 2 divided by 3 is giving us 41,200. So that is how we apportion the sales. Next, we go to cost of sales. So let us go back to the question and see the ratio we are supposed to use to apportion the cost of sales. So now we go to additional information number 8. So number 8, we are told that cost of sales and gross profits are apportioned according to sales, while all other expenses are apportioned according to time. So the same rate we have used to apportion sales, we are also going to use it to apportion cost of sales and gross profit. But cost of sales is made up of the opening inventory, the purchases, and then we have to deduct the closing inventory. So let us start with the opening inventory. That is the inventory on 1st July 2024. The amount we are given is 61,50. So let us now apportion that to the two periods. So in the first period, we are going to take 1/3 of 61,50. So 61,50 we divide by 3, that gives us 20,50. Then in the second period, we are going to take 61,50 multiply by 2 divide by 3, that is giving us 4,100. So that is for the opening inventory. Next, we go to purchases. So from the question, the amount of purchases is given as 38,700. So now let us apportion 38,700 using the same rate. In the first period, we take 1/3. So 38,700 divided by 3, that is giving us 12,900. And then for the next period after admission, we take 38,700 multiply by 2 divide by 3. So that is giving us 25,800. Let us now go to the closing inventory. We are supposed to less closing inventory. So in the question, closing inventory is given in the additional information number 5. We were told inventory as at 30th June 2025 was valued at 74.25. So we are going to apportion 74.25 using the same rates. So the period before admission, we are going to take a third. So 74.25 we divide by 3. So that is giving us, because we are supposed to deduct, we are going to put it in brackets. That is 24.75 in brackets. And then in the next period, we will take 74.25, we multiply by 2, we divide by 3. That will be 49.50. So now we want to find the cost of sales. So cost of sales will be given by opening inventory, add purchases, less closing inventory. In the first period, the cost of sales is 20.50 plus 12.900 minus 24.75. So that gives us 12.475. And then for the period after admission, the cost of sales will be 4,100 plus 25,800 minus 49.50. So that gives us 24,950. So now we want to deduct the cost of sales from the sales figure to get the gross profit. So we put the cost of sales in brackets. So in the first period, gross profit will be given by sales. The sales is 20,600 minus the cost of sales 12,475. So the gross profit is 81.25, and that is for the first period before admission. For the second period after admission, you take the sales figure 41,200, you deduct the cost of sales 24,950. So the gross profit will be 16,250. So now we are done with the first part. We go to the second part, which is expenses. So the first expense we have is insurance expense. So let us go to the question and find the amount for insurance expense. So in the trial balance, insurance expense is given as 4170, but there is an adjustment that you are supposed to make. So we go to the additional information. Point number 7 says accrued expenses included 30,000 for insurance and 250,000 for rates and rent. So for insurance, we are going to take 30. So the other figures were in thousands, so we will take 30. So we will take 4170, we add to 30, and then that is what we are supposed to have as our total insurance expense. So that is what we have done here. 4170, the one given in the trial balance, we add 30, which is the accrued insurance expense. That gives us 4,200. So once we have 4,200, we want to apportion it into the two periods. So let us go back to the question and find the rate we are supposed to use. So in the additional information, number 8, it says cost of sales and gross profits are apportioned according to sales, while all other expenses are apportioned according to time. So insurance is among the other expenses. So we are going to apportion that cost according to time. So 4,200 will be apportioned according to time. In the first period, we are going to take the share for 5 months. In the second period, we take a share for 7 months. So therefore, 4,200, we are going to multiply by 5 divided by 12. So 4200 times 5 divided by 12. So that is giving us 1750. Then in the next period, 4200 we are going to multiply by 7, then we divide by 12. So 4200 times 7 divided by 12, that is giving us 2450. We go to the next expense. So we go to the trial balance. After insurance, the next expense is rent and rates, and the amount given in the trial balance is 2150. So this one also is going to have an adjustment. If we go to additional information number 7, we were told accrued expenses included 30,000 for insurance and 250,000 for rates and rent. So we are going to take 250, we add it to 2150 to get the total amount for rent and rates. So rent and rates, 2150 added to 250 gives us 2400. That is the total expense for the year. Then we apportion it into the two periods. In the first one, we multiply 2400 with 5 divided by 12. So 2400 multiplied by 5 divided by 12 gives us 1000. That is for the first period. For the second period, we are going to multiply by 7, then we divide by 12, and that will give us 1400. We go to the next expense, which is wages and salaries. So wages and salaries, the amount given there is 8400. But one thing we are supposed to note is that these wages and salaries is for employees, not the partners. At the top, in the first paragraph, we were told that the partners were paid annual salaries of 1.2 million and 1.5 million. So we don't account for partners' salary the same way we account for employees' salary. So the 8400 does not include salaries to the partners. So go to the additional information number 1. We were told that Carol has been the office manager, and for the year commencing 1st July 2024 was on a salary of 1440,000 per annum. So because during that period she was still an employee, that is, before she was admitted, she was still an employee, the salary she was paid is supposed to be included in the employee's salary. And then any salary that she was paid after being admitted should not be included in the income statement. Instead, it should be included in the appropriation part. So how much salary was Carol paid for the first 5 months before she was admitted as a partner? So note that the 1440 is for 1 year per annum. So you just need to take 1440, you divide by 12 to get the salary per month. And then you multiply what you get with 5 to get the salary for 5 months. So that is what we are doing here. 1440, you multiply by 5, you divide by 12, that will give you Carol's salary for the first 5 months. So once you divide by 12, it gives you 120. Then when you multiply 120 by 5, it gives you 600. So remember, in the trial balance, the amount of salary that we are given is 8400. 8400, we want to deduct the amount that was paid to Carol. The reason being, the salary that was paid to Carol does not belong to the last 7 months. It does not belong to the last 7 months. It belongs to the first 5 months. Therefore, we don't want to apportion it the way we are apportioning other expenses. So the salary she was paid should only be included in the first 5 months and not in the last 7 months. So when you take 8,400, you deduct the salary that was paid to Carol in the first 5 months, you will be left with 7,800. So 7,800 is the salary paid to other employees, not including Carol. So we are going to apportion 7,800 the same way we have apportioned the other expenses, insurance and rent and rates. So in the first period, we are going to take 5/12 of 7,800. And then we are going to add the salary that was paid to Carol, because this salary belongs to the first period and should not be included in the second period after admission. So 7,800 multiplied by 5 divided by 12 gives us 3,250. And then we add 3,250 to 600, which is the salary Carol was paid before she was admitted as a partner. So the amount we are getting there is 3,850. So 3,850 is the total of this. The part of the salary that was paid to other employees during that time, plus the salary that was paid to Carol during the first 5 months. So wages and salaries for the last 7 months will be 7,800 multiplied by 7 divided by 12, and that will be 4,550. So we go to the next expense, which is bad debts. So in the question, we go to the trial balance, look for bad debts. So bad debts, the amount is given as 636. We don't have any other information concerning bad debts, so we are going to apportion it according to time. In the first period, we take 5/12 of 636. So 636 times 5 divided by 12, that gives us 265. And then in the second period, 636 times 7 divided by 12, that gives us 371. We go to the next expense, which is depreciation. So according to the trial balance, we have exhausted all the expenses in the trial balance. So now we go to depreciation. In number 9, we are given the rates for depreciation. You are told that depreciation is provided per annum at the following rates. Motor vehicles, 25% on a straight line basis. Equipment, 20% on reducing balance. So let us start with motor vehicles, 25% on straight line basis. So when you are told it is a straight line base, it means you multiply by cost. So 25% we are going to multiply by the cost of motor vehicles. In the trial balance, motor vehicle at cost was given us 4,800. But there was another motor vehicle which was introduced by Carol, which we must also consider. So according to additional information number 3, you are told that Carol introduced a motor vehicle valued at 600,000. So that motor vehicle now belongs to the business, and we have to calculate depreciation for it as well. However, depreciation for this motor vehicle belongs to the second period, the last 7 months. So in the first 5 months, we are not going to show depreciation for this motor vehicle because it did not exist at that time. So let us start with the first one, 25% of this, and then we take 5/12 of that for the first period. So first, the depreciation for the whole year for the motor vehicle they had at the beginning of the year is 1200. So 25% multiplied by 4800 gives us 1200. So this 1200 will be apportioned according to time. So 1200, first we take 5/12 for the first period before admission. So 1200, you multiply by 5, you divide by 12, that will give you 500. So 500, that is the depreciation for the first period. And then when you go to the second period, the same depreciation you are going to take 7/12. So 1200 multiply by 7 divide by 12 is going to give us 700. So the 700, you add depreciation for the motor vehicle that was introduced by Caro. So remember the cost was 600. If you take 25% of 600, it will give you depreciation for the whole year, but the motor vehicle stayed in the business for 7 months only, up to the end of the current financial year. So we will take that depreciation for that motor vehicle and then apportion it according to time as well. So 25% of 600, that gives us 150. So 150, you multiply by 7, you divide by 12, gives us 87.5. So 87.5. So in total, depreciation for the last 7 months is going to be 787.5. So that is the one you are going to recognize as depreciation expense for that period. So next, let us calculate depreciation for equipment. So in the question, in additional information number 9, the rate of depreciation for equipment is 20%, and it is calculated on reducing balance method. So reducing balance means you multiply the 20% with the net book value of equipment. So when you go to the trial balance, the cost of equipment was 15,450. We want to deduct accumulated depreciation for equipment so that we can get the net book value. So accumulated depreciation for equipment was given as 6690. So take 15,450, deduct 6690 to get the net book value. So 15,450 minus 6690 gives us 8760. So we multiply 8760 with the rate of depreciation, which is 20%. It gives us 1752. So 1752 is the depreciation for equipment for 1 year. Now we want to apportion it according to months. For the first period, we are going to take 1752, we multiply by 5 and then divide by 12. That gives us 730. Then in the second period, we are going to take the same amount, we multiply by 7, then divide by 12. It is going to give us 1022. So now we are done with all the expenses. So what we are going to do, we are going to sum up the expenses starting with the first period. So we start with the insurance expense. 1750 plus 1000 plus 3850 plus 265 plus 500 plus 730. That gives us 8095. Because this is the total expenses, we want to deduct total expenses from gross profit to get the net profit, so we put it in brackets. We go to the second period, we add all the expenses from the insurance expense. So we start with 2450 plus 1400 plus 4550 plus 371 plus 787.5 plus 1022. So the total expenses for the second period is 10,580.5. So now we are going to deduct these expenses from the gross profit. So you take the gross profit for the first period, 81.25 minus 80.95. So that gives us a net profit of 30. Then go to the second period, take the gross profit 16,250, deduct total expenses 10,580.5. That gives us a net profit of 5669.5. So now that we have the net profits, we want to perform the appropriation. We want to apportion that profit to the partners. The first thing, we are going to start by deducting the salaries to all the three partners. So let us go back to the question and find out the amount of salaries we were given. In the first paragraph, we were told that Anita and Banse are in partnership, sharing profits and losses in the ratio 3:2, after charging annual salaries of 1.2 and 1.5 to Anita and Banse respectively. So for Anita, we have 1.2, and to Banse we have 1.5. But these are annual salaries. So for the first period, we are going to take salary for 5 months only, and then for the next period, we take salary for 7 months. So we start with Anita. So the 1200 annual salary, we take salary for 5 months only. So multiply by 5, divide by 12. That gives us 500. For the next period, we are going to have 1200 multiplied by 7 divided by 12. That is 700. And then we go to Banse. The annual salary is 1500. So 1500 we multiply by 5, divide by 12. For the first period, the salary will be 625. For the next period, the salary will be 1500 multiplied by 7, divide by 12. That is 875. And then finally, Caro. In the first period, Caro was an employee, not a partner. So therefore, her salary was already included in the income statement, in the profit and loss statement, because she was an employee. So the only salary we are going to show here for Caro is for the period after admission, because that is when she was a partner. So we take her annual salary, which is 1440, multiply by 7, divide by 12. So that gives us 840. So because these ones are paid by the business to the partners, we are supposed to deduct them, so it is best to put them in brackets because we are supposed to deduct them. So next, let us calculate now interest on capital. So we will go to the question and find the amount of capital for the three partners, starting with Anita. So in the trial balance, we were given the capital accounts. For Anita, the amount is 3750. And then the rate of interest. In the first paragraph, the last sentence, we were told that both partners are allowed one-time interest at a rate of 4% on opening capital accounts. So one-time interest means the interest is only paid in the first year just once, which means in the subsequent years they will not be paid interest on capital. So normally the rate that is quoted here is usually an annual rate. The 4% is supposed to be an annual rate. But because the first period is only 5 months, we are not going to calculate interest for the whole year. Instead, we are going to calculate interest for just the first 5 months. So remember, the 4% is the rate they used before admitting Carol. So you are going to take 4%, multiply by 3750, and then we also apportion it for 5 months only. So that is what we are doing here. 4% multiplied by 3750, and then we take interest for just 5 months. So 4% multiplied by 3750, then you multiply by 5, divide by 12. That is giving us 62.5. 62.5. And then for the next period, remember the rate of interest changed after admitting Carol. So that was shown in additional information number 2, where it says interest on capital at the end of the year was a one-time rate of 5%. So note that this is the rate they were using as at the end of the year, and that was the period after admitting Carol. So again, the 5% is supposed to be an annual rate for 1 year. So we are going to take interest just for 7 months. So that is what we are doing here. 5% multiplied by the amount of capital for Anita, and then you take interest for only 7 months. So 5% times 3750 multiplied by 7 divided by 12. This gives us 109.375 or 0.4 in 1 decimal point. Next, we go to Banse. In the question, in the trial balance, the capital for Banse is 3,000. We are going to use the same rates and the same apportioning method to get the interest for each period. So in the first period, we take 4% of 3,000, and then we take interest for 5 months only. So 4% of 3,000, then multiply by 5, divide by 12, gives us 50. And then for the next period, we have 5% times 3,000 times 7 divided by 12 gives us 87.5. Next, we go to Carol. So first, let us determine the amount of capital Carol introduced. So this one was given in number 3. Carol introduced a motor vehicle valued at 600 and 1.5 cash as part of her capital. So we are supposed to add these two to get the total amount of capital that Carol introduced. So 600 plus 1500, that gives us 2100. And then we are going to use the rate at the end of the year, which is 5%. And then we are going to take interest for only 7 months. So that is what we are doing here. The total capital is 2100, and it is going to be shown in the second period only. So because in the first period Carol was not a partner yet, we are not going to show any interest during that period. So it is only going to be for the next period. So 5% multiplied by 2100 multiplied by 7 divided by 12, that gives us 61.25. So into one decimal point, you can say it is 61.3. And because these are going to be deducted, the interest on capital is supposed to be deducted, we are going to put them in brackets. So now that we have recorded the interest on capital, in the question we were not given any information concerning interest on drawings. So normally we are supposed to add interest on drawings, but in the question there is no point that tells us the partners charged interest on drawings. So we don't have that in the appropriation part. So now we want to determine the amount of profit or loss that is going to be shared by the partners. So we are going to take our net profit, we deduct all these expenses, and then whatever remains is going to be profit to be shared by the partners. So let us start with the first period. 30 minus 500 minus 625 minus 62.5 minus 50. It is giving us a negative, and that is negative 1207.5 for the first period. And then for the second period, take the net profit 5669.5, deduct 700, and then 875 less 840 less 109.4 less 87.5 less 61.3. That gives us 2996.3. So that one is positive, the other one is negative. So from there, we want to record the profit shared by each of these partners. In the first 5 months, Carol will not have any share because she was not a partner during that time. But in the second part of the year, she's going to have a share because she was a partner during that time. So therefore, to share the loss in the first period, we are going to use the old profit and loss sharing ratio before Carol was admitted. So let us find out what the ratio was. So the ratio was given in the first paragraph, where it says Anita and Banse are in partnership sharing profits and losses in the ratio 3:2. So that loss will be shared using that ratio. So in the first half, we are going to have, Anita is going to take 3/5 of, is going to take 3/5 of 1207.5. So let us calculate that. 3 divided by 5 multiplied by 1207.5. So that gives us 724.5. And then for Banse is going to take 2/5 of the same loss, which is 12 1207.5. So let us calculate that. 2 divided by 5 times 1207.5. That gives us 483. So for Carol, during the first period, she will not have any share. So at the end of the first period, the loss will be shared and we will be left with 0. So now let us go to the second period, the last 7 months. So first, let us confirm the profit sharing ratio. So in the second paragraph, we were given the ratio on 1st December 2024. They admitted Carol and agreed to share profit and losses in the ratio 5:4:3. So we assume this is 5 is for Anita, 4 is for Bansi, and 3 is for Carol. So that is the ratio we are going to use. So 5 plus 4, that is 9. 9 plus 3, that is 12. So Anita is going to take 5/12. So 5/12 we multiply by the profit for the second period, which was 2996.3. So let us calculate that. 5 divided by 12 times 2996.3. So that gives us 1248. So in one decimal point, we can say it is going to be 0.5. And then for Bansi is going to take 4/12 of the profit, which is 2996.3. So let us calculate that. 4 divided by 12 multiplied by 2996.3. It is giving us 998. In one decimal point, we can say it is 0.8. And then for Carol is going to take 3/12 multiplied by the profit, which is 2996.3. So we calculate that. 3 divided by 12 times 2996.3. That is giving us 749. In one decimal point, we can say it is 0.1. And because we are supposed to less share of profit, we are going to put these ones in brackets. So once you deduct the share for each partner, the last amount is supposed to be 0. All the profit is going to be shared by the partners until you have nothing remaining. So for the loss we are supposed to add so that we can arrive at 0. For the profit, we are supposed to less so that we can arrive at 0. So from there, we can say we have concluded the profit and loss statement. The question did not require us to prepare a current account, but we have to prepare it as part of our workings. So now let us prepare a current account for all the partners. The first thing, we are supposed to start with the balance at the beginning of the year. That is the balance brought down. So let us go to the question and find the opening balances. In the trial balance, the current account for Anita, the amount is 1500, and for Bansi, the amount is 1050. Because Carol was admitted in the current year, she does not have a balance brought down in her current account. So we are just going to record for Anita 1500 and Bansi 1050. So Anita 1500, Bansi 1050, Caro, we don't have opening balance. So from there, let us make adjustments to reflect the admission of Caro. And here we are just going to show the goodwill part, because the capital introduced is supposed to be recorded in the capital account. But in the current account, we can adjust the goodwill on admission. So let us make the workings for goodwill. So goodwill was given in number 4. On 1st December 2024, goodwill was valued at 3.6 million and is to be written off. So remember, this goodwill was not paid in form of cash. So therefore, we are just going to credit the current account to the old partners using the old profit sharing ratio. And then to write it off, we are going to debit the current account to all partners using the new profit sharing ratio. So let us do that. In the current account, we are going to recognize the goodwill. So the amount we are going to share is 3.6 million. And remember, we are going to share using the old profit sharing ratio, which was 3:2. For Anita, we are going to take 3 divided by 5 multiplied by 3600. So Anita is going to take 2160. And then Bansi is going to take 2 divided by 5 times 3600, which is 1440. And Caro, as the new partner, she does not have a share in that goodwill. But on the other side, which is the debit side, we are going to show goodwill written off. We are going to show goodwill written off, but now we are going to write it off using the new profit sharing ratio. So for Anita, it is the same ratio we have used to share the profits in the last 7 months. So Anita is going to take 5 divided by 12 multiplied by the goodwill, which is 3.6. So Anita, we will have 1500. Bansi is going to be 4 divided by 12 times 3600, which will be 1200. Caro is also going to have a share. Her share is going to be 3 divided by 12 times 3600, which is 900. So we have recorded the goodwill on admission of the partner. The other workings to show the admission of Caro, they are supposed to be done in the capital account. But because we are just going to add the amount for motor vehicle, which was left out, we are not going to be opening the capital account. The working will be shown in the statement of financial position. So now let us proceed with the current account. Everything that has been shown in the appropriation part is supposed to be shown in the current account. So let us start with the salaries. The salaries are paid by the business to the partners. So we are going to be crediting the current account with the salary paid to each partner. So we start with Anita. Now we don't need to apportion anymore. We just take the full amount of salary for the whole year. So it was 500 plus 700. So before apportioning, the amount was 1200. So for Anita, salary for the whole year was 1200. For Bansi, salary for the whole year was 1500. That is what we had. Here for Bansi, 625 plus 875. And then for Caro, the salary that she was paid as a partner is 840. We are not showing the salary that she was paid while she was still an employee. So as a partner, we are going to credit her with 840. So next, we are going to record the share of profit and loss. If it is a loss, we are supposed to debit the current account. So let us start with the loss. Share of loss for Anita and Bansi. So this is for the first period. So for the first period, Anita had a share of 724.5. 724.5. Bansi had a share of 483. Carol was not a partner during that time, so she doesn't have a share of that loss. On the other side, we have share of profit. We have also skipped interest on capital. So we have interest on capital and then share of profit. So share of profit, now we have the three partners because it was for the last 7 months. Anita, the share of profit for the second period was 1248.5. Bansi, her share of profit was 998.8, and Carol, her share of profit was 749.1. And then we include their share of interest, interest on capital. Now this we have to add the first period plus the second period. So starting with Anita, interest on capital, the first period for Anita was 62.5. We add her share for the second period, 109.4. So in total, Anita will have interest on capital amounting to 171.9. We go to Bansi. Bansi, the first share was 50, the second share was 87.5. So when we add those two, we are going to have 137.5. So 137.5. And then for Carol, her interest on capital is only for the second period, and that was 61.3. So 61.3. So after we have recorded everything in the appropriation part, now the next thing is to show their drawings. Remember, we don't have interest on drawings, but in the question, the partners had made drawings. So let us go to the question and determine the amount of drawings for each partner. So the drawings amount for Anita is 1800, and that one for Bansi is 2250. So let us record those ones. We debit the current account. Bansi 2250. So if we had interest on drawings, we would have recorded it on the same side as drawings. So I think that is everything. Let us now calculate the balance carried down, which will be taken to the statement of financial position. So let us first find the totals on the credit side. So after making all the additions, these are the totals we get for current accounts, and these are the balances carried down in the partner's current account. So next, we will proceed with the statement of financial position. and we start with the non-current assets. So the non-current assets, we start with motor vehicles. So motor vehicles, we have 4,800 plus 600. This is the cost of motor vehicle that the partners had at the beginning of the year. And then the 600 is the one that was introduced by Carol because the adjustments had not been done. So in the question, we were told in additional information number 3, the last sentence, we were told the only entry made in respect of Carol's admission was 1.5 million paid into the bank account. So no adjustment was made for the motor vehicle. That is why we are adding it. So the 600, we are adding it to the cost of motor vehicle, 4,800. And then after we add, we want to deduct the total depreciation for motor vehicle. So total depreciation first, let us take the accumulated depreciation as at the beginning of the current financial year. So accumulated depreciation for motor vehicle is 2,850. That was as at the beginning of the year, 1st July 2024. So 2,850, we are going to deduct here 2,850, and because that was at the beginning of the current year, we also deduct depreciation that was charged in the current year, which we can obtain from the profit or loss statement. So depreciation for motor vehicle, we had 500 for the first period and 787.5 for the next period in total, including the one that was introduced by Carol. So we add those two, and then we deduct from the cost of motor vehicles. So the total is 1287.5. That is the total depreciation that was charged in the profit or loss statement. So now let us do the workings. 4,800 plus 600 minus 2,850 minus 1287.5, that gives us 1262.5. 1262.5. So that is the net book value of the motor vehicles. So next, let us go to the equipment. Let us check the cost as given in the trial balance. So the cost of equipment is given as 15,450. So 15,450. First, we are going to deduct the accumulated depreciation on equipment, which is 6690. So let us deduct 6690, and then we are going to deduct depreciation for the current year, which we included in the profit or loss statement. So depreciation for equipment for the two periods, we have 730 for the first period plus 1022 for the second period. So in total, we are going to deduct 1752. So that is total depreciation in the profit or loss statement. So let us do the workings. So 15 450 minus 6690 minus 1752, that is giving us 7008. So now we want to add the two. the two non-current assets. So 1262.5 plus 7008 is giving us 8270.5. 8270.5. So now let us go to current assets. In the current assets, we have inventory. Inventory was given in the additional information, and that is number 5. Inventory as at 30th June 2025 was valued at 74.25. So inventory, we have 74.25. Another current asset we were given is trade receivables. So trade receivables, that one is given in the trial balance as 55.29. So we include that one, 55.29. So now we want to add the two current assets. So 74.25 plus 55.29. So the amount we are getting is 12,954. Yeah, 12,954. And then we want to combine the total for current assets with the total for non-current assets. So 12,954 plus 8270.5. So total for the assets is giving us 21,224.5. So next we go to financed by. Financed by, we are going to start with the capital accounts. So let us go to the question and look for the balances for the capital accounts. So for Anita, the amount is 3750. For Bansi, 3,000. So Anita, we have 3750. Bansi, we have 3,000. And then for Carol, we are going to use the additional information, number 3. So we are going to add the capital in form of asset 600 and the capital in form of cash 1,500, which gives us 2,100. 2,100. Next, we go to current account. So current account, we are going to take the balances we have in the current account, in the partner's current account. So Anita, we had 2255.9. So that is the one we are going to show there, 2255.9. And then for Bansi, the balance carried down was 1193.3. So that is the one we will bring here, 1193.3. And then for Carol, the balance carried down was 750.4. So that is the one we will bring here, 750.4. Next, we go to current, but before we go to current liabilities, let us find the totals. Let us find the totals for this. So the total is going to be, take 3750, you add 3,000, you add 2,100, you add 2255.9, you add 1193.3, you add 750.4. So the total is 13,049.6. So now we can go to current liabilities. The first item we have there is trade payables. So we go to the question and find the amount for trade payables. So trade payables, the amount is given as 7040. That is the trade payables amount, 7040. So we record here 7040, and then we had bank overdraft. So let us find the amount for bank overdraft. So bank overdraft, the amount is 855. So we record here 855, and then remember we also had accrued expenses in the additional information. That was number 7. We were told that accrued expenses included 30,000 for insurance and 250 for rates and rent. So we are going to take 30 and add it to 250. That will give us 280. So accrued expenses, we are going to have 280. So now we are going to add the current liabilities. So 7040 plus 855 plus 280, that is giving us 8175. So 8175, we are going to add it to the total for capital account and current account, 13049.6. So that is giving us 21,224.6. So when you compare the total with the other total that we had, the other total was, the total for assets was 21,224.5, and this one is 21,224.6. So there is a small difference of 0.1. So we can say that that is an insignificant difference. So therefore, we take this as a correct answer. So that is the statement of financial position. It actually is the simplest part of this question. So the hardest part is the income statement, because we have to apportion the income and the expenses. Now that you have seen how to prepare the statement of profit or loss and the statement of financial position and also the current account when a partner is admitted, so try to solve the next question. The next question is taken from December 2023. That is CPA, December 2023, question 3. So this question is slightly different from the one I have done, but it is a bit easier than the one I have done. So one reason why it is easier is that here the partner is admitted at the beginning of the year. So notice what it says in this sentence. On 1st November 2021, an employee, Oliver, was admitted as a partner. So did you note the date of admission? It was 1st November 2021. And when does their financial year end? Their financial year is ending on that 1st October 2022. Oliver was not admitted in between the year. Instead, Oliver was admitted at the beginning of the financial year. So therefore, you're not going to have two columns the way we have had them in this income statement. You're not going to have a column before admission and another column after admission, because the partner has stayed in the business for the full 12 months. So for you, it is just going to be one column. That is one thing which makes it a bit simple. The other thing is that here the goodwill was paid in form of cash. So notice what this sentence says. He was to bring 1750 thousands as capital and 1680,000 as his share of goodwill. So here the goodwill is being paid in form of cash, but if you know how to account for this, it should not be a problem. You just have to debit cash account and then you credit capital account to the old partners only using their old profit sharing ratio. And then notice what the other sentence says, that the partners do not intend to open a goodwill account. So you will not be having a goodwill account in the statement of financial position. However, you are not told to write the goodwill off. Unless you have been told that the goodwill is to be written off, you are not supposed to write it off. And in this question, you are not told to write the goodwill off, so you are going to just recognize the goodwill and leave it just like that. You just credit the partner's current account and then you leave it that way. And then another thing, you are told that the admission of Oliver has not been fully recorded in the books of account other than the cash record. So what do you get? Take the 1750, which is the capital introduced by Oliver, add 1680, which is the amount of goodwill Oliver was required to pay. You get 3430. Then when you go to the trial balance, look at the capital accounts. We only have Kate, Mercy, and Nixon. So those are the capital balances. We don't see anywhere Oliver, which is what they mean when they say that the admission of Oliver was not fully recorded in the books. So he is not yet recognized in the capital account. However, the amount that you have seen for Oliver has been recorded in this trial balance. So we are given here Oliver's account 3430. And which column is it shown? It is shown on the credit column. So this is just the amount you are going to apportion because this combines the capital and the goodwill. So part of it is capital, part of it is goodwill. So 1700 you are going to credit to the capital account for Oliver. 1680 you are going to credit to the capital account for the old partners. And nowhere in your financial statements are you going to show Oliver's account 3430. So that is the only adjustment you're going to do. Eliminate this balance. Instead, take it to the capital account. The capital amount to appear in the column of Oliver. The goodwill amount to appear in the columns of the other partners. So you can try this one. Even the additional informations, there are no complications. It's supposed to be very easy. So that is the end of the lesson. See you in the next lesson.